Hello, everyone. Today on the Final Bar, I'll be talking with John Kosar of Asbury Research. We'll see what his models are telling him about the current market environment. It's all about semiconductors today. Nvidia's earnings really powering that group onward and ever upward. Ladies and gentlemen, this is the Final Bar. Hey everyone, welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in these markets. Using the power of technical analysis, the technical toolkit is really optimized to help you better understand these markets by focusing on the message the markets provide back to us in the form of price and trend and momentum. We have a lot of different indicators to apply to these markets, try to understand what's happening, to try to focus on leadership and laggardship, what's working and what's not working. At the end of the day, it's all about price, and that is the foundation of technical analysis, is a thorough analysis of price and volume to better understand market dynamics. So what do we take away from a day like today when Nvidia, AMD, semiconductor names up significantly? Nvidia, in fact, is actually now the top-ranked stock in our StockCharts scooter rankings for the large cap space. We're going to look at those in particular, look at the ripple effects of this move higher on other parts of the market, how other certain sectors not participating at all on a day like today. And I think once again, we have a certain area of the market doing very, very well. Other areas of the market, very much not so. We've talked to a number of our guests about those sort of things recently, and we'll get into it a little further today. Let's get right now into our market recap. Let's focus on what happened and what long-term conclusions we can draw from what we learned today in the short term. As I mentioned, big day for part of the market, but not so much elsewhere, right? If you have a day when Nvidia is up 20, 25%, big mega cap name, obviously, in the technology sector. It's interesting that the NASDAQ up 1.7%. That makes sense to just below 12,700. The S&P have a decent up day as well, up 0.9% to 4151. The Dow managing to be negative on a day like today. So it's so fascinating that you have certain areas of the market doing quite well, other parts not participating at all. On this day when Nvidia's up 25%, the NASDAQ up almost 2%, NASDAQ 100 up 2.5%, small caps actually shed 1/3%, going lower. So again, this sort of dynamic of the haves versus the have-nots just continues to be reinforced. I was talking with Grayson Rose. We grabbed a coffee earlier today, and we're debating how this ends. And it's not going to end well for something, right? Either these overheated names become much less overheated when everyone realizes how extended they are, or the rest of the market really starts to participate. But you have to assume that something has to give here when we have a further and further disagreement between what's working and what's not. The VIX, by the way, yesterday we talked about the big move higher in the VIX, just above 20. Today coming down, right? So you have the market rallying, you have volatility lightening up. The VIX down just above 19. That's almost a full point below where it was yesterday. So still sort of looking to see if we have an overall improvement in volatility or an increase in volatility. Today, giving some of that back, I would say we're still sort of, it certainly appears to be that we're in a period of where the volatility is starting to increase again. We'll have to see how things play out here. Let's look elsewhere. You can see that interest rates, for the most part, moving higher. We're going to look at the chart of that 30-year, the long bond yield here in a few moments. Just above 4% today, and that's pushing, again, to the upside. 10-year yields above 3.8%, 5-year point right around 3.9%. Short-term yields still around 5.2% on the short end of the curve. So again, that's that inverted yield curve that we've talked about many times. The dollar actually moving higher. So again, sort of a risk-on feel overall with the major averages, but the dollar actually pushing higher, about 0.5% higher for the UUP. Commodities, for the most part, in the red today. Gold and silver continuing to move lower. We're going to look at the maybe the GDX. I'm not sure where we'll go if we have time for it, but the GLD, sort of spot gold, down about 1%, silver down almost 1.5%. Besides copper in the green, pretty much everything else in this space in the red. The energy sector having a pretty tough day after most of this week actually leading the way higher, outperforming the rest of the markets, the rest of the equity sectors. Bitcoin currently around 26,500. That's up about 0.6% from yesterday. Ether as well, up about 0.7%. That's just above 1,800 to 1,812. Sector movements, boy, it was technology and then everything else. And you could argue it's been that sort of theme in 2023. But very much an exclamation point on that sort of dispersion of returns from strong to weak. The technology sector, the XLK up almost 4% today and just continue to push higher. Again, Nvidia earnings really the story, which we'll dig into from a technical perspective. After that, only two other sectors in the green, industrials and real estate, and not by much. Everything else is basically flat to down, and utilities, healthcare, energy, all down over 1%. Energy leading the way lower, and this is after part of this week, much of this week, up until today. Energy's been the bright spot, where others have been a little more risk off. Let's look at a daily chart of the S&P 500. I just want to spend a moment just seeing what we learned today. So a gap higher on the S&P. Again, the range that we've been in here, I don't think there's a change yet, right? So while you see semiconductors powering to new highs, you see stocks like Meta and Nvidia sort of pushing higher and making new highs for the year, or at the very least new swing highs. The S&P itself still range bound, right? And that 4,200 level remains the resistance from February. That remains the resistance from the last week. Until we're able to eclipse those levels, I question how much further we can go, certainly, right? To get to a big gain, you have to start with a small gain that eclipses a key level of resistance. Beyond there, we have that 4,300, 4,325 level. That's a Fibonacci level. That's the August 2022 highs for the S&P 500. So you have sort of a confluence of resistance a little bit above current levels as well. So the question I would say at this point with any of these names that have moved is the sustainability of the rally, right? How far these trends can persist before something has to change. And again, it's not lost on me that the S&P really testing significant resistance. Many individual names certainly testing some key resistance as well. Let's look at interest rates here very briefly. We usually use $TNX, which is the 10-year yield. I just wanted to shake it up and look at the long bond yield. Again, it's not too different between these two, to be honest with you. What's interesting about the 30-year point today is just breaks above 4%, and we've sort of bounced off of a low around 3.55 or so in March and April. That's after the February and December moves down around to that 3.5% point. Keep bouncing off of there. Once again, bonds are selling off a bit, and as a result, rates are going higher. You can see that the 4% level we're at in the 30-year is right about where we were at the beginning of March, right about where we were at the end of December. This has been sort of the upper boundary for the long bond yield over the last 6 months. So if this would change, right, if this is a change of character, if this is something new, I would argue 30-year yield needs to get above 4%. That would be something like the TLT breaking down through support, maybe like the AG, some of those bond ETFs based on bond prices would have to be breaking down through support. They're sort of trading to the lower end of that range. So we're really close to where bonds may be exiting this sort of range that they've been in. Certainly interest rates over the last 6 months have been range bound. Long bond yields been between around 3.5% to 4%. We're at the upper end of that range, which means I'm normally expecting a bit of a move lower, right? I'm going to expect resistance until proven otherwise. We get much above 4%. All of a sudden, it looks like we may be setting up for further deterioration in bond prices, further upside in interest rates could be from a technical perspective. All right, I've delayed about enough. We have to talk about semiconductors and the gap we've had higher. Yesterday on the show, earlier in this week, we talked about Nvidia, right? Certainly the largest name in that space, one of the biggest names in the technology sector. Now the top-ranked stock in our Scooter rankings using the large cap universe. We talked yesterday, right? Nvidia coming out after the close. The question is, this could certainly be a catalyst, right? Is there an upside surprise? In which case, where does it go from here? Does it eclipse the previous highs, or is it a disappointment? And we start to look at the 50-day. We start to look at previous support. Question has been answered for now, and certainly resolving to the upside. I mean, if you read about the earnings call, if you listen to the audio if you look about a lot of the commentary around this, I would argue it's all about AI and the promise of AI, and comments from Nvidia basically suggesting that this is the future, right? There's so much upside to this technology. I was looking just recently, the ChatGPT, the OpenAI website is now one of the top 20 websites in the world. Very quickly, out of nowhere, has rocketed to one of the top things up there with things like WhatsApp and other popular websites. So impressive how quickly this has become a thing we're all talking about. But Nvidia basically saying this is impacting their business and has the potential to dramatically impact their business to the upside, even further than what the market has been pricing in. This is causing Nvidia to gap higher by about 24% today. It's causing all the semiconductor names, for the most part. We'll get to Intel here in a few moments. But Nvidia, MPWR, of course, all sort of having this nice move higher. And MPWR, not a particularly attractive chart a couple days ago, right? All of a sudden it's, or earlier in the month of May, this is a stock gapping down. It's below its 200-day. So, what has changed between then and now? And this is where I feel that charts, a lot of times, while it may not always have the answers, certainly should lead you to some of the questions to answer, right? What is different from Monolithic Power Systems with the world when it's at 400 versus the world when it's at 488 a couple days later? What have we learned that's different? Again, it's this optimism about AI and their ability to impact a lot of this space, but I would question how much the world has changed between those 2 points, and does it justify these fluctuations that we've seen? Probably not. The question is, which of these is wrong, right? Are we overvaluing or undervaluing a name like this as it's gapping all over the place? Now, having said that, Nvidia, MPWR, a lot of the other semiconductor stocks moving higher. Let's compare that to something like Intel. Now, what's funny is about a year ago, we did a March Madness themed stock picking exercise, and we picked stocks in a bracket between different names. And one of the matchups I remember having was Nvidia and Intel. And it was an opportunity to just reflect on how different those businesses were in terms of Intel with chips for computers and a small subset of things in terms of how their business is structured versus Nvidia, which is really leveraging sort of this future of AI. While Nvidia gapping higher by 25%, Intel managing to gap lower by 5.5%, plunging below its 200-day moving average. So interesting that even within this space, you've got divergences. It's a good reminder for me to not just think about the top level headlines, to focus on the charts, see what's moving, see what's working, see what's not working, and then start to draw some conclusions based on the weight of the evidence. Folks, let's take a quick commercial break. We'll be back with today's guest, John Kosar of Asbury Research. We'll see you in a minute. Hey everyone, welcome back to The Final Bar. This is Dave Keller here at StockCharts.com in Redmond, Washington. So good to have you join us every weekday after the close. We appreciate you doing so. Couple quick announcements before I bring on today's guest, John Kosar. First off, we're going to do a really cool all mailbag show tomorrow. We'd love to feature one of your questions live on the air. You can email us your questions at thefinalbar@stockcharts.com. We're on Twitter at FinalBarSCTV, and we are indeed on the YouTube. Go to our Stock Charts TV channel on YouTube. Put a comment below the video you're watching. We'd love to hear from you. We'll hope to feature one of your questions in our mailbag show tomorrow. In terms of the upcoming schedule, I mentioned tomorrow we're going to do a bunch of mailbag questions. Also, our latest episode of The Pitch just airing today. So go to our YouTube channel, go to StockChartsTV.com if you missed that one. Dave Landry, Mark Newton, Joe Rabel did a fantastic job sort of talking about some of the key themes and what stock and ETFs could work in this environment. Next week, 3 solid guests for you. Pete Carmesino of Chaikin Analytics is going to be joining us on Tuesday. On Wednesday, a new guest, Mike Singleton. Mike runs a firm called Invictus Research in the DC, Baltimore area, and he'll be jumping on the show, more of a macro strategist. Then on Thursday, June 1st, Leslie Juflas of Trading Live Online is going to be joining us live in our studio here in Redmond. So make sure you check out all those upcoming guests. I want to bring on today's guest, John Kosar. John's been a frequent guest on my show, a frequent guest host on Stock Charts TV. Does a great job with Your Daily 5. Many of you have seen his work there. He's the chief market strategist at Asbury Research, coming to us from Chicago. John, welcome back to the show. How are you?
I am fine. It's good to be here.
Good to see you. It was awesome to see you in New York for the CMT Symposium. We were talking about the 50th anniversary. Both of us super excited to see a mentor and friend, Ralph Acampora, among the rest of the technical analysis royalty that was there. But it was awesome to see you and catch up a bit for sure. Big day today with semiconductors gapping higher. We've had leadership, narrow leadership in a lot of ways. Talk us through how you're perceiving this world. We have your chart of the S&P to start with. What are you seeing here?
I started with this because what you're seeing with the red highlight is not a normal market. Markets don't normally drift sideways for 6 months. It makes it very difficult for people that are following the trend because trend following tools don't work well in this kind of an environment. So here's kind of where I think we are right now. A couple of highlights to watch here just over the next couple of days. 4096 in blue, that's the 50-day moving average. If you follow that back, it's basically loosely contained the market on the downside since, like right in there. What do you got there? A couple of 2-3 months there. What's not shown on the chart, because I didn't want to make the chart too busy so you couldn't read it, is the trend line that you draw down from the August highs of last year comes right down and intersects with the 50-day moving average. So watch that 40.95 area. Watch the low that we made yesterday. I think that's important enough to where if we break it, I think we go down and at least test the 200-day moving average, which you could see at 39.76 in orange. And everyone knows where the top side is, right? It's 4,200. We've been banging our head against that for months. So while we're stuck here, what I've been focusing on is how do you make money in a sideways market where these trends are really too short for a lot of people to take advantage of? And the answer to that is looking for relative outperformers, looking to see where the money is going as we're churning in this 400-point range in the S&P. So we've got a couple of charts coming up, and I'll show you what I use to identify those. So this is our SEAF model. SEAF stands for Sector ETF Asset Flows. I've built the model 5 to 7 years ago, and what it does is it tracks the asset flows within the 11 sector spiders, looking for the most, it's kind of measuring the speed of the money that is moving around those 11 sectors, which together are essentially the S&P 500. So what you see up here, there are 3 columns: trading, tactical, and strategic. 3 different time frames, because I want to see a trend going across time frames. I just don't want to say, hey, this was really good on a monthly basis over the past week. I want to see a trend. And what we show here is we take anything that is favored is from 3 to 15. Those are highlighted in green here under ranking up in the upper right corner. So you can see there are 3 sectors there. We have technology, XLK. We have communication services, XLC, and consumer discretionary, XLY. XLK has been one of the top 3 sectors according to the model 13 of the past 21 weeks. Wow. So XLK has been the most present in terms of having money go there. XLC has been one of the top 2 over the 8 of the past 9 weeks. So those are the 2 that we like. The 2 that we're avoiding is basically the flip side of that. The money is going into technology and services, communication services, XLC. It's coming out of energy and financials. So that kind of helps me to see where the opportunities might be. So
and it's amazing, those FANG sectors sort of firmly at the top of this list. And I mean, not surprising given some of the individual names if you think about it. Let's look at a couple of those charts in particular. Let's start with the XLK. What is it about this that's so strong according to your work?
Well, XLK showed up as a SEAF buy in the beginning to latter part of January. And this was based on asset flows. This wasn't based on a breakout on the price chart or any kind of relative performance, but I started to see the money shifting there. And the good thing about SEAF is it's usually in front of the money, because first the money moves and then the price moves, right, because of the money movement. So what we show here is since January the 18th, XLK has outperformed SPY, the S&P 500 ETF, by 17%. So even though trying to trade the S&P 500 directionally has been a very frustrating time, this was a very good outperformer during that period. Then if you look up at the top, down on the bottom, let me explain, is the relative performance between XLK and SPY and its 63-day moving average. Why 63 days? That's a business quarter. And here at Asbury, we're looking to try to catch these trends that are quarterly in nature. Hopefully we catch something with some legs, so we're not in and out of a trade in 2 weeks. So what we have on top, that's XLC daily with its 200-day moving average in orange and its 50-day moving average in blue. So you can see it's kind of been sitting on the 50-day since the middle of March. March 13th was that last test. Then we came up and tested it again on April 25th when I was in New York to see you. And then you can see very recently, the past 2 weeks, we've broken out of that high that we made back in August of last year. It's at 151.86, and the 50 days coming up right underneath it at 149.42. As long as we stay up above there and we continue to outperform, I'm not going to try to be smart enough to say when this is going to end or when it's overdone or when it's time to get out. The market will tell me by looking at this chart and watching those asset flows on the CEF model. As long as those assets keep going in there, it's going higher.
I love it. And that the essence of your CEF model, from my interpretation, it's not just what people are saying. It's not like people are in a survey and answering a question of what they like. This is how people are voting with their capital, right? You're following the asset flows, and when people are putting assets somewhere, that's the vote, right? That's the vote that's really important, right?
It's totally quantitative, totally data driven. All I'm doing is I'm following what the AUMs are in these 11, and we've come up with a strategy. We've come up with a methodology, is what I should say, to measure the movement of that money in 3 different time frames, both in and out of the market. So that's, to me, everyone's got an opinion, right? And there's trend lines that are broken every day. There's a lot of day-to-day volatility that kind of affects the way the markets are traded now. They don't trade like they used to trade 10 years ago. That intraday volatility is kind of financial jujitsu, is what I call it. I think a lot of times these algos try to get us off sides one way and then turn it right up the other way. I was in the trading pit for 20 years at the CME. I saw the locals doing it. Now you see guys with a lot of money doing it with computers.
So the move today in semiconductors, obviously pretty extreme to the upside. I'm bringing up a chart of the stocks here. I'd love to get your take on a day like today, John. Let's say someone has brilliantly bought semiconductors in, January and just has been riding this wave higher. I'd personally start getting nervous when there are these gaps higher, right? Because you worry about the sustainability of the move. When you're looking at the chart of the stocks, does it feel like this is a trend with further upside to go? Or at what point do you start getting nervous when something's had a run like this?
No, I look at it as opportunity. Take a look at those highs across from February. So we've got a bunch of, there's 4 highs there. So we gapped above those today. And that gap indicates urgency, right? So that gap, it's called a breakaway gap because we've broken out of the range and now we're higher. So as long as that gap is not filled, that's a clean breakout. And this could be the start of a move. Technology needs some help, right? We all know technology needs some help. If we got some help from the stocks in terms of strength and especially relative outperformance versus SPY, I think that could be some medicine for the market going forward. The other thing that I noticed here just over the past week is that SOX has started to outperform SPY or SPX, whichever you prefer, on a 63-day basis. So it's the beginning, it looks like, of a new trend of quarterly relative outperformance versus the broad market. So I'm watching this one close. This could be a little bit of help coming in for tech to get a little bit more breath in there. And maybe some different types of stocks that can help keep us close enough to 4,200 in the S&P 500 where we can eventually maybe facilitate some kind of breakout if we get a little bit more breath, a little bit more help from other areas of the market.
So we only have about 30 seconds left, John, but if I could briefly ask you about energy. I know a lot of people are tempted to bottom fish in a space like this where technology is strong. Energy has been one of the weaker places. Is that something you'd be encouraging or discouraging, and why, here briefly, if you could?
Great question. And I wouldn't do it because if you go back and look at that CEF, the CEF table, our CEF model, energy is one of the 2 weakest. And it's the weakest. If you go over underneath tactical, it's the second from the bottom, energy. You can see that is number 11. So that means in terms of assets out, it was the weakest in the week ending last Friday. So these are always a week old. We update them on the weekend. And then the final one there, I think it was either the 10th or the 11th. So you have a lot of money exiting there on a tactical and on a strategic basis. I want to see some inflows before I bite on that trade.
Let's go ahead and follow the money as always. John, listen, it's a pleasure to get your take. Good to see you again. Great to see you recently in New York, and hope to see you again soon, all right?
Same here. Thanks for having me.
That's John Kosar. John's the Chief Market Strategist at Asbury Research, coming to us from Chicago. He has an Asbury 6 model and the CEF model. And what I love about John, there's a consistency to his approach. There's an objective nature to looking at the data points and focusing on the weight of the evidence. And I love that way of thinking about flows and thinking about some of the growthy areas of the market versus things like energy and financial, and waiting for the markets to tell you when it demands your attention. Great take there, as always, from John Kosar of Asbury Research. Folks, we got to wrap the show and go to the 3 in 3. Here are 3 charts in 3 minutes that tell the story of this market environment. Chart number 1, I have to start with semiconductors. I mentioned leading up to today's show. It was all about Nvidia's earnings. I think we saw certainly a nice upside surprise, certainly renewed optimism in an area of the market that has been one of the stronger areas going recently. We're looking at some great charts with John Kosar there. We looked at the stocks. I have a weekly chart of the SMH, just looking at the longer term trajectory. And what I like about the weekly chart, it just shows a very clear rotation from strength in 2021, weakness in the first 3 quarters of 2022, and then a nice reversal to the upside in 2023. The momentum is strong, but not excessive. The relative strength is strong as well. And again, when my answer to a question like that is I'll wait for the market to tell me that the trend is no longer in place. But as a trend follower, I'm a big fan of following the weight of the evidence in the form of price. And I think at this point, semiconductors continuing to show strength to the upside. Again, if and when that trend turns, the weekly chart's going to illustrate that, the daily chart as well, and then we can be concerned about the market environment. Chart number 2 is looking at new 52-week highs and lows. I was thinking about it as Nvidia is gapping higher, and I was starting to look at breadth data on stocks making new 52-week highs and lows. We don't have all the data in yet, so this chart is not quite updated for today, but I will tell you one of the interesting environments or interesting conditions of the current environment. Not a ton of stocks making new 52-week highs relative to historical raging bull market phases. And I think that goes back to John Kosar's first chart about the S&P and sort of that range-bound sideways range we've been in. We talked with a number of our guests about the range-bound nature of stocks, the S&P between 3,800 and 4,200, and what the opportunities can be at a time when the benchmarks are still sort of struggling to break out of this range. If I'm bullish in this market, I would want to see a lot more green on this chart going forward, because the green histograms measure the number of stocks on the New York Stock Exchange, the S&P 500 on the bottom panel, making new 52-week highs. There needs to be that leadership, and not just Meta and Nvidia, but a bunch of other things starting to break to new highs to really power the S&P, I think, above 4,200 or 4,300 or more. So I'm looking at this chart to see if we can see some more green. Not enough yet, I think, to get really optimistic. Finally, gold. I was hoping to ask John Kosar about gold. We didn't get to get there, but I did get his take on energy, which I appreciated. Gold has struggled, right? It's been one of the stronger areas of the market in 2023 up until the beginning of May. All of a sudden, starting to retrace to the downside. The GDX, the GLD have now broken their 50-day moving average. I'm interested to see that the GDX, gold stocks, now oversold. And I think that might be an interesting one to keep an eye on to see if we get some sort of bottoming pattern as we near a potential confluence of support. We have the 200-day not too far below and a Fibonacci level right around $29. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close for the Final Bar. All of our previous interviews, some great discussions, can be found for free on our YouTube channel, also at StockChartsTV.com. Special thank you to John Kosar of Asbury Research joining us from Chicago. For StockCharts, I'm Dave Keller. Have a great night. We'll see you tomorrow.